This is going to be a walkthrough of some problems that will help you on exam 4 for the course that I am tutoring for. Exam 4 covers chapter 12 and chapter 14 of the McGraw-Hill Managerial Accounting homework book. So question 1, Latin Corporation has entered into a 7-year lease for a building it will use as a warehouse. The annual payment under the lease will be $4,781. The first payment will be at the end of the current year. Okay, so that's important. It's end of the year, and all subsequent payments will be made at the end of the year or year ends. If the discount rate is 6%, the present value of the lease payments is closest to. Okay, so we're going to do equals negative PV, just because I forget where to put it. Then the first thing they want is the rate. The second one is the number of periods. The third one is the payment. If you didn't put the negative in front of the PV, then you could also put the negative in front of the payment. I can leave future value type, and I can leave future value and type empty. So the present value is closest to 26688. All right, question 2. James just received an inheritance check of $8,000 from the estate of his deceased rich uncle. James wants to set aside enough money to pay for a trip in 5 years. So in 5 years, he wants to go on a trip. If the trip is expected to cost $5,000, how much of the $8,000 must James deposit now if the rate of return is 12% per year in order to have $5,000 in 5 years? Okay, so again, I'm going to go equals negative PV. They want the rate, the periods, 5 years, and the payment. I'm going to leave that blank. So you can either put 0 or just put another comma because we don't have a payment. We want to know a future value of $5,000. So again, if you didn't put the negative in front of the PV, then you would put the negative in front of the future value. Correct answer. So he needs to put 2,000, so it's closest to 2,835 for this answer. Question 3. Ignore income taxes. Okay. Okay, ignore income taxes in this problem. By-Right Pharmacy has purchased a small auto or car for delivering prescriptions. The auto was purchased for $29,000. It will have a 6-year useful life and a $4,800 salvage value. Delivering prescriptions, which the pharmacy has never done before, should increase gross revenues by at least $32,800 per year. The cost of these prescriptions to the pharmacy will be $26,600 per year. The pharmacy depreciates all assets using the straight line method. The payback period for the auto is closest to. So they gave you a lot of interesting information, but not all of it is relevant. So we just need, for payback period, we need to do the initial investment divided by the cash flow. So we have an increase in revenue of 30,800, and the cost or negative part is 26,600. So the payback period is 4.7 years. And the reason that we don't worry about depreciation, salvage value, is because the payback for this auto is going to be before salvage value comes into play. Salvage value doesn't come into play until year 6, and this is going to be paid off partway through year 5. It's 4.7 years. Question 4. Ignore income taxes in this problem. Okay. The management of Stanford Corporation is investigating automating a process. Old equipment with a current salvage value of 24,000 would be replaced by a new machine. The new machine would be purchased for 426,000 and would have a 6-year useful life and no salvage value. By automating the process, the company would save 147,000 per year in cash operating costs. The simple rate of return on the investment is closest to. Okay, so the simple rate of return is the annual incremental yearly savings divided by the initial investment. And in this case, so the annual incremental net operating income is the annual incremental savings. And the other thing, the initial investment. So the new machine is $426,000, but they are assuming that we're going to use this old machine salvage value of right now of $24,000 to pay down on that new machine cost. So we'll get to that in a second. So my yearly savings are $147,000. Depreciation, and if you'll remember, so the new machine has no salvage value. So straight line depreciation is the old machine, no, it's the new machine total cost minus any salvage value, which was 0, divided by the useful life in years. So my depreciation every year is going to be $71,000. So I take my savings minus my depreciation to get my annual incremental net operating income or yearly savings. Okay, so I'm going to take that yearly savings divided by the initial investment, which was the cost of the new machine minus the salvage value of the old machine. So my simple rate of return is 18.9%. Question 5. Ignore income taxes in this problem. The following data pertain to an investment proposal. The cost of the investment is 40,000. The savings annually is 11,000. Estimated salvage value is 5,000 in 5 years with a 10% discount rate. Use Excel or a financial calculator to solve the net present value of the proposed investment. Okay, so I need to find out what the savings the present value. So the present value of the savings would be equal to the savings times 1 minus 1 plus the rate raised to the value of the negative years divided by the rate. So again, this is the formula from the amortization table. The other way you could do this is to do out 5 years and do the savings divided by 1 plus the percent raised to the value of which year it is to get those discount factors from the first appendix. But we're going to use Excel. So net present value. The other thing I think I could have done would have been to find the present value of the savings equals negative PV rate, comma, periods, comma, and the payment. And again, you could put the negative in front of the payment, but I always forget which one to put it in front of, so I put it in front of the PV. So the present value, yep, exactly. So it's exactly the same. So you can memorize this long formula, or you can just do the present value of the savings. And then I need the present value of the salvage. So again, I could do that whole long formula, or I can go equals negative PV. So it's the rate, the number of periods, the payment is blank because this 5,000 is the future value. And again, I put the negative in front of the salvage value if I didn't put it in front of the PV, but that's not how I do it. Okay, so that gets me the savings and the salvage value. So net present value means that you take the cost, or no, other way around. You take the present value of the savings plus the present value of the salvage minus the initial cost. That's how you get net present value, right? These two up here, those are present value. So be very careful as you're reading things. There is a big difference between present value and net present value. And again, that net present value is the present value of the savings plus the present value of the salvage minus the initial investment or the cost. And that gets me to net present value. So it's closest to, because of rounding, that's why it's a couple of dollars off, but I'm very confident that the answer is 4,806. Okay, question 6. We're ignoring a lot of taxes in this problems. Okay, ignore the income taxes in this problem. The management of Cantel Corporation is considering a project that would require an initial investment of $47,000. Whoops. No other cash outflows would be required. The present value of the cash inflows is 66,080. The profitability index of the project is closest to. So profitability index, they've given us everything. We don't have to do anything but just calculate the profitability index, which is the present value of the cash inflow divided by the initial investment. So 1.41. Question 7. Allen College has a telephone system that is in poor condition. The system can either be overhauled or replaced with a new system. The following data have been gathered concerning these two alternatives. So we've got the present system information and we've got the proposed system information. Let's see what is relevant. Allen College uses a 12% discount rate and a total cost approach to the net present value analysis. Both alternatives are expected to have a useful life of 8 years. Use Excel or financial calculator to solve the net present value of overhauling the present system. So let's see, what was the overhaul cost? So we're just looking at the overhaul cost, and I'm going to put that in as a negative because it is a cost. The salvage value in 8 years is $2,000 at the present system. And that yearly operational cost is $30,000. Okay. So there's several ways to go about this. The overhaul is a noun. Let's see if we can figure this out. So the present value of the cash cost equals negative PV. The rate periods was 8. The payment 30,000. Okay. So there's my yearly operating cost. So it's actually a negative number. So I actually want that to be negative. I don't want to put that there. Okay. The overall is cost. And what is the present value of the salvage? So negative PV, the rate, periods is 8 years. I don't have a payment, so I'm going to leave it, do another comma, or you put a 0, and then the future value is the salvage of $2,000. So its present value of the salvage is 808. So let's see. So I'm going to take and this is because I have negative numbers. I'm going to take the negative 80,000 plus the negative 149,029 plus the positive of 808. And that way Excel is going to add and subtract for me because some of these are negative. And I'm coming up with a net present value of negative 228,221, which is the first one. That's one it's closest to. It's only a few dollars off. So again, find the present value of the yearly cash cost and the present value of the salvage. And then remember the overhaul is now, so we don't need to find the present value. So then the net present value would be the overhaul, the present value of the yearly cash cost for 8 years, and the salvage value in 8 years. All right, question 8. This one is basically all over question 14. Take a screenshot or something because I have taken these amounts that they've given us because they want us to calculate the following for year 2. So I've just taken these numbers and copied them down here. So I don't have to scroll up and down. Just notice this little part here where you get your total dividends, your market price per share, and your total shares of common stock outstanding is 100,000. Okay, so gross margin percentage. They want to know what percent gross margin is of sales. So you take gross margin divided by sales. And this is again for year 2. And that is a percentage. Okay, dividend yield ratio. So the dividend per share, I took let's see, what did I take? How did I get that 60 cents? So to get that 60 cents, I took the dividends of 60,000 and divided it by the number of shares of stock to get the dividend per share of 60 cents. And market price per share was given to me. Return on total assets. So this one is equal to net income plus open parentheses interest expense times open parentheses 1 minus the tax rate close parentheses divided by total average assets. That is not the right answer. I did something wrong. Let's try that again. So again, this average total assets, I just looked above, found the total assets for year 1, year 2, added them together and divide by 2 to get my total my average total assets. Let's try this again. Equals net income. Oh, that's what I did wrong. I'm mixing up parentheses. Okay, open parentheses. Net income plus open parentheses. Interest expense times open parentheses. 1 minus the tax rate. Close parentheses. Close parentheses. Close parentheses. Okay. Now divide by total average asset. Gives me 12%. Okay, so I need to fix this. There should be a parentheses at the beginning, and then I need 3 parentheses before the dividing. So lots and lots of parentheses, and this is a long formula, but it's pretty straightforward. Okay, book value per share, you're going to take total stockholders' equity and divide by common shares outstanding. And I got the wrong answer. The reason is in this balance sheet, they gave it to us in thousands of dollars. So they have taken 3 zeros off. When they gave me the common shares, they did not remove any zeros. So this is the actual number of common shares. My stockholders' equity is actually 839,000. So I can either add the 3 zeros back or take 3 zeros off of the common shares. So I'll do first where I take the number they gave me, first equity, divided by taking 3 zeros off of common shares outstanding, 839. And just to show you I'm not crazy, you can add 3 zeros to the equity, divide by the number of shares they gave you, and get 839. So if you get a weird number, make sure that you have got these in the same format. If they have removed 3 zeros, then you need to remove 3 zeros or add 3 zeros and use this number that they gave you. Current ratio is just current assets divided by current liabilities. And acid test ratio is cash divided by accounts receivable. Nope, that's wrong. Ah, so acid test ratio is my quick assets divided by my current liabilities. So in this problem, cash and accounts receivable are my only quick assets. So I'm going to take and add cash plus accounts receivable and divide by current liabilities. And it is not a dollar sign, it is just a number. Okay, accounts receivable turnover is equal to sales for year 2 divided by the average accounts receivable. Again, you get the average by taking year 1 accounts receivable plus year 2 accounts receivable and then divide by 2. And that is not a dollar sign. That was so helpful. Okay. Average collection period is then equal to 365. Whoa. Nope. 365 divided by accounts receivable turnover. Okay. Inventory turnover is equal to the cost of goods sold divided by the average inventory. Again, average inventory is going to be year 1 plus year 2, divide by 2. And then you have the cost of goods sold from year 2 divided by average inventory. Average sale period then is 365 divided by the inventory turnover. And then the times interest earned is going to be the earnings before interest expense and taxes divided by interest expense. And debt to equity ratio will be equal to total liabilities divided by stockholders' equity. All right, good luck on the exam.